A lot of traders hear the term funded account and immediately think prop firms. But what I want to talk about here today is something slightly different. And honestly, I think this is going to be one of the bigger trends that we see going forward. See, not everyone understands how these funded style broker accounts actually work, why the brokers even offer them in the first place, and what's really happening behind the scenes. So, in this video, I want to break it all down: how they function, why they exist, and what you should be thinking about before you ever consider using one. No hype, no recommendations in this video, just clarity. So, first, let's clear this up. These are not prop firm accounts, and it's important to understand this. What I'm talking about here today is not the traditional prop firm model. So, you're not passing any challenge, you're not paying for a reset, and you're not trading a simulated capital pool hoping for a payout. These are broker based funded accounts or bonus style accounts. They look similar on the surface, but structurally they exist for very different reasons. And once you understand those reasons, a lot of things start to make more sense. So let's talk about why brokers even offer this in the first place, because they're not doing it out of charity. There are three main reasons why a broker is offering this. The first is because it's a marketing play. Plain and simple, this is a massive client acquisition tool. So if a broker says deposit X and get 20%, 50%, two times your money, or even 10 times your capital, that obviously grabs your attention immediately. So especially for newer traders who are undercapitalized, this feels like an opportunity that they simply can't ignore. And from the broker's perspective, it's actually an extremely effective way to bring new clients into their ecosystem. Now let's go over the second reasons and how the investor side of the brokerage actually works. And this part doesn't really get talked about enough. See, behind the scenes, most of these programs often allow the investors or the liquidity partners to earn returns that are higher than traditional low risk investments like a CD from a bank. So instead of money sitting idle or earning 2 or 3%, they can actually be deployed in a way to generate yield, which allows the broker to not only make more money, but also the investor can make more money as well. Which leads me to my third part. And this is the part that traders typically overlook. See, when an account has balances that are larger, the spreads, the commissions, and the fees also scale up with it. So even if the broker offers the bonus capital, they're actually going to be benefiting from increased volume in every transaction because it's an increased size. So even if you're making money or losing money, the broker is going to make more money because the business incentive is a higher balance means higher fees. Now, to be clear, only a few brokers are really going to offer these types of incentives. Not all the brokers are going to do it because they don't, quite frankly, need to. But really, over the years, we've seen promotions come and go. So some brokers in the past have offered 20% bonus accounts, 50% bonus, 2x, 5x, and I've even seen up to 10x in certain cases. And this is where traders, they can get excited about potential profits, but they need to slow down because bigger numbers doesn't automatically mean better conditions. See, each structure, depending on the broker, will come with different strings attached. Some may have different withdrawal rules. Some may just be consistent withdrawal rules. Some will have different risk parameters while others won't. And some may just have different limitations on a certain amount of capital that can receive the bonus versus the entire amount. And these are extremely important because you need to know how to approach your strategy and what you attach to the broker, whether it's the software, whether it's your self trading, in order to make sure that you're capitally efficient and making money from your trading activity. So, for example, let's say that you decided to manually trade on one of these brokers. You would want to make sure that whatever trades you're entering, your portfolio doesn't experience a drawdown that will wipe out the account equity. So, in a logistical example here with numbers, if you're on a 10x account and you put all the money that's in your account on one trade, well, if that trade drops by 10%, well, then the amount that you deposited can get liquidated. So let's say you entered into a trade and you have $10,000 in an account. The account is now trading with a $100,000 balance for this example. If the trade goes from 100,000 down to 95,000, but then back up to 110,000 where you would take profit, your entire account would only experience a 5% drawdown, but for your initial capital, that would be 50%. Now, on the flip side, in this example where your account went from 100 to 95 to 110, well, you close out the trade at 110,000 and you only put $10,000 in the account. That means that you just made 100% on your money with that 10% swing. Now, for professional traders that are experienced, you probably understand this concept, But if you're a business owner or investor or someone who doesn't really stare at charts all day, you've probably heard of algorithmic trading software that can help you execute these trades for you. Now, if you go down this route, you want to ensure that whatever software that you're pairing with your account, the max drawdown ever experienced in that software is compatible with the type of funding that you're receiving with the account. And if that's something that you're interested in, there's a link in the description that you can click where I break down softwares more in detail and more in depth. And you can actually book a call with me or my team members to see if our software is maybe a good fit for you. But by and large, if you're analyzing softwares, you just want to make sure it's compatible with the broker and the funded account that you are looking for. Now, before you go open all of these broker accounts that are funded and start trading or using software to trade in them, I want to make a very clear point. Personally, I don't recommend any specific brokers because I don't think that you should rely on just one. See, if you're serious about trading or adding algorithmic trading to your portfolio, you're going to want multiple broker accounts. And the reason why is because spreading your capital also spreads your risk. See, over time, you're naturally going to figure out which platforms fit your execution style. These promos with different brokers may not last forever, so you want to ensure that you're not just solely locked into one broker. You're also going to see which ones have the best conditions for you and really which ones align with your long-term goals. So there really is no universal best broker. That's actually something that each trader has to discover for themselves because of the preferences of UI, the preferences of support, and obviously all the due diligence that goes into seeing if that broker is legitimate and is going to be around for a very long time. So if you're considering one of these funded style, bonus style broker accounts, here's how I think that you should approach it. Not emotionally, not because of the leverage, not because someone on social media flexed a payout, but do it with due diligence. See, you should be asking yourself and the broker, what are their withdrawal rules? How do the drawdowns work? How do their fees work? And most importantly, does the structure actually fit your strategy? So let me give you an example. This is actually of one of my clients who wanted to use one of our softwares and he was considering moving a substantial portion, actually multiple six figures to give you clarity on that, into our trading algorithms. And he wanted to take a portion of that and move it into one of these funded programs through brokers that are out there. But originally, he only wanted to start with $1,000 because that broker was new to him. And so, while logically that made sense to have a small allocation from his perspective into the new broker, it actually wouldn't have made sense if you wanted to layer in algorithmic trading. It actually would have made more sense from to manually trade that because the high frequency trading algorithms that we have, first off, they don't even work with $1,000. You're going to need a lot more than that in order to trade. But even if it did, the trading fees on each and every trade would actually eat at his returns. And I wanted to give him a proper baseline of the portfolio technology being layered in and him to actually see real results. And so the whole point of all this to tell you the story is if you are going to use one of these funded brokers and you want to layer in technology with it, you have to have enough of a capital base in order for technology to actually work. But if I didn't challenge him and go over the broker fees with him for the strategy he wanted, then he would have made an incorrect assumption and incorrect judgment. And so after further education and further calls, I helped him understand how much he should allocate in order to really test out the broker. And that actually ended up about being $35,000. And now the software, the portfolio, everything's running no problems. And he's taking profits as things are coming in. Now, here's why I believe that this trend is going to continue to grow, in my opinion, because this model actually fits in between the prop firm and the self-funded trading model. Let me explain. Because prop firms focus on challenges, can you have them to reset, buy accounts just to get access to capital and waive payouts, versus the other individuals who have a very large portion of capital that they can put in a broker, it actually gives retail traders the ability to actually use some of the strategies that these guys use. And prop firms, obviously, they can now compete for the beginner traders that want to deploy capital, that want to increase volume, and that also want to partake with algorithms, but simply just don't have the same capital as these guys over here do with larger lump sums. So for individual traders that sign up, they can get more flexibility, jumping through less hoops, they have more buying power, and they can potentially grow faster if they are trading themselves manually correctly and actually doing things appropriately with their portfolio. And they can also layer in algorithmic trading technology, which is also very cool. So really, guys, the real message I want to leave you with is that these funded style broker accounts aren't necessarily good and aren't necessarily bad by default. They're tools. And I'm seeing this trend actually continue to grow. And so with any tool, They can either help you or hurt you, depending on how well you understand them. So, this video isn't necessarily here to tell you what to use, how to use it, but it's mostly to show you how they actually function behind the scenes. That way, if you are considering one, when you do your own research, when you do your own due diligence, when you read the fine print on these brokers, you can make sure that it aligns with your risk tolerance with the broker, your risk tolerance with your strategy, and really with your goals when it comes to trading, investing. Because at the end of the day, the best advantage in trading isn't leverage, it's understanding the opportunities that are available in the market. And so if you like this video, I want you to go ahead and give me a like, subscribe, share it to some of your trader or investor friends of yours, and I'll see you in the next video.